You're listening to Bottomshelf Bitcoin, episode 26.
Relax. Enjoy your coffee. Okay. Good morning, everyone. Take a chill pill. Okay.
Hey everybody, welcome back to another episode of Bottomshelf Bitcoin, the podcast that puts Bitcoin knowledge within everyone's reach. As always, I'm your host, Josh Humphrey, and today my guest is Dhruv Bansal. He is the co-founder of Unchained Capital, and we're going to talk about what that is and the opportunities that are there. So Dhruv, welcome to the show.
Thanks, Josh. Thanks for having me on the show.
Yeah, so Dhruv, give us like a real quick pitch of what Unchained Capital is, and then I kind of want to go maybe a little bit into your background and then kind of flesh out some details of how you guys do things.
Sure. Unchained Capital, we are building financial products for long-term holders of cryptocurrency. In particular, what that means is today we sell a loan product. If you have Bitcoin or Ethereum and you would like to receive dollars and use your cryptocurrency as collateral to receive that loan, we're a vendor that will help you. There are a few competitors, but we think our service in particular, with our focus on custody and security, is one of the best choices.
All right, so tell us a little bit about yourself, like your background, maybe your educational or work experience, and then how you got into Bitcoin, and then how you got to Unchained.
Yeah, it certainly hasn't been traditional, but I can't imagine anybody who took a traditional path to get to cryptocurrency. So let's see. I started out as a scientist. I'm a physicist originally. That's how I was trained. I was working on a PhD in physics here in Austin, the University of Texas. I was a statistical physicist, which meant I was writing a lot of code, working with a lot of math, and eventually that led to a love and practice with data. I had a couple friends. My co-founder, Joe Kelly of Unchained, was someone I met back then, in that era when I was a grad student here in Austin. And he, as well as a third friend of mine, another physicist, we started a company called InfoChips. And our original ambition was to help scientists and other folks working with data in what came to be called data science or big data. Eventually, folks who were working in that area, make it easier for them to share data with each other online. So a platform for workers in the data field. But that company rapidly evolved. As we grew it, it turned into more of a tooling and platform company. And so I sort of found myself in the position of, working on a PhD in physics, dropping out to start this, entrepreneurial venture, which I thought was very much around data, but turned out to be a lot more around technology. Learned how to build an actual real company with customers, and grew it up to a good number of folks. And then we sold the company in 2013. And it was a great success. I made a little cash and I bought some Bitcoin, which was a great move, 2013, good for me. And I managed to hold on to it, which was even more remarkable. Believe me, I think like most people who've been holding Bitcoin for a while, I definitely was tempted to sell. Bitcoin's been very volatile over that period, but it has grown a lot. But more importantly, buying Bitcoin in 2013 helped me realize that there's not too much you can do with it. That's probably even true even till today. Bitcoin and most other cryptocurrencies are speculative assets. You buy them because you think they're going to go up in value. They have. Hopefully they will continue to do so. But there's not too much else that you can get in terms of value out of these currencies. You either realize your gain by selling, or you continue to hodl and hope for the best. And so Joe and I, both now Bitcoin owners, kind of coming off of our last startup, thinking about what our next project was, we thought, man, that's the problem to solve. Because if Bitcoin or other cryptocurrencies are really going to become useful, it's got to be more than digital mattress money. There's got to be short-term value like lending or liquidity or derivatives or fixed income. There's got to be value that we can extract from these asset classes just while we hold them, just like we can with real estate, stocks and bonds, other kinds of securities. And so Unchained really eventually rose out of those ideas. We're Bitcoin, believers. We're going to hold this stuff for the long term. Wouldn't we like services like we could get with other assets while we continue to do that? That's kind of how Unchained got started.
All right, real quick. You're I think, the third person from UT that I've had on this show now. And so I've got to say, Bitcoin has moved me in a way that I never would have thought that, so many great people could have come out of Austin. So no, I went to A&M, so that was
crypto and Texas go together, I think, and I think in a lot of ways, right? We have like the whole "don't tread on me" kind of spirit, and crypto is very much about that. I think politically there are a lot of libertarians in Texas. The University of Texas system is a great system. There's a lot of smart people coming through there that get exposed to each other, and I think even energy, right? We've got a lot of wind. We've got a lot of folks in the oil industry in Texas, and to a certain extent, miners of proof of work chains like Bitcoin are subject to some of the same constraints and modes of thinking as folks in the energy industry. So I just think there are a lot of reasons why Texas as a whole, and Austin in particular, are really good places for crypto folk. I certainly know a lot of great folks in the industry right here in Austin.
Now, this is Unchained is cool to me. I was kind of reading, after we met, and I went back and kind of researched it. I love this idea because, hodling takes a certain mental fortitude, I think, especially when the price goes up. And I can't imagine having held it since 2013 because I'll be honest, I kind of kept going back and forth in December, like, do I sell or do I buy more? Like, how far up is this going? And so having had it that long, I can't imagine, but that's something I've thought, like, you should be, like, in a sense, like, you will be rewarded in the long run, hopefully, if the price continues to rise or we get hyper Bitcoinization or whatever. But right in the short term, you're not getting anything for it. So I love this idea that you can use it for something else as well.
And a lot of people may not need anything else from their Bitcoin or their Ether or their other cryptocurrency holdings in the short term. They may not have a lot to begin with, so it's not a big deal, but they're not, quote unquote, getting additional value from their $500 of Bitcoin that they have. They may have a lot of wealth outside their cryptocurrency. So, it's not hurting them that they're sitting on a bunch of crypto and, quote unquote, it's not doing anything. But I think there definitely is a population of folks who, either got lucky with crypto or Bitcoin and Ether in particular, and those really blew up on them and they're sitting on a good amount of wealth and they don't really have that much wealth maybe outside that category, or folks who are already, have debt in other ways in their normal life and want to take on some asset-backed debt based on their cryptocurrencies because they're grown so large. So really, truthfully, the folks that we can probably help and who have a real pain point that our lending product can alleviate today, it's a small number because it's who has a lot of crypto. There are many of us, but in aggregates, we're still a small population. So our market is still pretty tight, narrow, but all of us talk to each other. So that's why it's really especially useful for me to get on these podcasts and try to reach out and find other folks who, maybe like me, have been holding Bitcoin or Ether for a long time and didn't realize that there were other options beyond buying and selling and maybe considering lending or borrowing as something they might be interested in.
So how does it work? Like, if I want to take out a loan, I come to you guys and then what? Like, so I send you my Bitcoin as collateral?
Yeah, when we talked about crypto and lending, there's a couple ways you could interpret that. We could be taking your cryptocurrency and lending it out to other people to help you make money. There are a few services which do things like that. That's not what we do. We do exactly what you described, which is if you have crypto but you want to get dollars and you don't want to just sell your cryptocurrency, because of course that's always your easiest, maybe first idea is if I've got a bunch of Bitcoin and I would like dollars, just sell the Bitcoin. Boom, you get dollars. But in a situation like that, you lose out obviously on all future gains that Bitcoin or Ether or whatever it is that you sold might have. But you also have to pay capital gains taxes. So if instead you borrow, which is to say exactly as you said, you give Unchained or some other lender in the space your collateral, your cryptocurrency, and they give you dollars in an asset-backed loan, you don't have those capital gains consequences. You still technically own this asset. You are still exposed to the future gains that it's going to have. You've just leveraged it. And, depending on the lender, there's some rate, there's some payment scheme that you'll be paying for the privilege of getting that cash while still being able to hold your position.
And so what do you guys do with the Bitcoin or the Ether? Is it just Bitcoin and Ether?
Those are the only two asset classes in crypto that we work with today. Yes, Bitcoin.
Okay.
We definitely hear from our customers that they'd like us to work with Bitcoin Cash, Litecoin, Monero, Zcash, ERC20 tokens. And I think all of those are on our roadmap eventually, but considering the market cap today, Bitcoin and Ether covers a huge fraction of it. And that's kind of what we've covered so far.
Okay. And so what do you do with it? Like, how does that work? Like, walk me through the process, like, of me sending it to you, or what do you do with it when I've sent it to you? How do I know that it's safe?
Yeah, we don't do anything with it is the answer. I think in the future, we may want to do things with it. We may want to what's called rehypothecate it. Like, if you've given it to us, we may want to lend it out. We might be able to give you a lower rate. We might be able to even get you some income by doing things like that. But for the short term, especially because this is still a nascent and new industry, and we want to maximize the amount of trust you can put in us. So for right now, as you asked, let me describe the process. Come to our website, put in your email, sign up just like any other web service you've ever used, get a username and password, 2FA protection. Once you're in there, we're going to ask you to go through a KYC AML process. So we'll need your name, your address, your social security number. We do not perform any kind of hard credit checks or anything like that. So it's not going to affect your credit score or get on your credit report to work with us. But we do need to know who you are. That's part of the requirements for us to be able to legally work in the United States. So assuming you've gone through that process and we're able to approve you for lending, the next step is, you apply for a loan. You tell us how much crypto you want to put in, or equivalently, how many dollars you need to borrow. You tell us how long. Our loans range between 3 months and I think 5 years. I believe our average loan is 2 years. So you tell us how long you intend to borrow for. Tell us why you're borrowing, and of course, are you borrowing in Bitcoin or Ether? And we'll turn around a set of terms to you. Interest rates, our average APR today is between 12 and 14% per year. And if you decide that you like the rates, you like the term, you want to work with us, you'll sign your papers, DocuSign, just like any other online legal transaction you've engaged in. And then you will get an address. That address is a real address. It's a real Bitcoin address. If you're working in Bitcoin, Ethereum, it's a real Ethereum address. In particular, we can get into security and custody later, but in particular, it's a multi-sig address backed by cold storage, hardware wallets. It's a really safe place to store your collateral. And we'll ask you to fund that address with the appropriate amount of either Bitcoin or Ether that you need as per the terms of your loan. Once that collateral hits that address, you can use any wallet you want to send it there. We'll see it. Once it's enough, we'll send you a wire transfer, and then your loan begins. You're going to be sending us interest-only payments every single month. And at the end of the term, once your loan is due back, you can either pay us back the full principal that we lent you. You can ask us to sell some of your collateral to cover your obligation, or you can renew the loan. So there's a lot of control that you have. Going back to your question of what do we do with the collateral while we have it, the answer is nothing. That address that we gave you that you put your collateral into, it stays there. You can use any block explorer or any other open source tool you like to confirm that it is sitting in the address you put it in when you originated the loan with us. And we think that's a feature that we really like. It would make me feel a lot safer as a borrower. It indicates that we don't use exchanges. We don't just defer to a third party and give them the funds and have no idea where they actually are. No, they're on the blockchain and they're sitting in an extremely safe custodial model. And it provides, I think, a large amount of transparency to borrowers, which makes it a lot easier to trust our service. After all, the reason you are borrowing and not selling that Bitcoin or Ether is because you value it and you think it's going to be worth more. The last thing you want is for it to be lost because you tried to get a loan against it. And that's part of the reason we spend so much time and energy creating solutions like this, which hopefully give our customers a lot of transparency and confidence when they use our product.
So you said it's a multi-sig wallet. Now, who controls those signatures?
Right. Today, it's correct to say that the addresses we give our customers and our borrowers to use are multi-sig addresses. All the keys that are part of the quorum, that multi-sig quorum, all the keys are held by representatives of Unchained Capital. So in that sense, it's a single institution, our own, that you have to trust when you work with us. We're aware that's a sort of imperfect solution. We felt that was the right place to start with our product offering, and we've been lending in this model for about a year. We're actually the oldest running crypto-backed lender in existence, and we've been using this model the entire time. But very soon, actually, and I'm happy to be able to talk about it very briefly on the show with you, very soon we're going to be extending that model. And instead of having a multi-sig address that we have all the keys to, we're going to open it up. And we're going to allow you to have a key, we'll have a key, and we'll have a third-party escrow agent that we're working with, and they'll have a key as well. And we'll make it 2 out of 3. It's already multi-sig, but we'll make it 2 out of 3 in particular. And that way you have some rights to it while it's with us. And you know that we can't just abscond with it. That would require either collaboration from you or the third-party escrow agent. And if we were to disappear, you could still work with the third-party escrow agent to recover your funds. And so it's the same kind of redundancy that we already have with our internal multi-sig solution, but it also provides, I think, a greater degree of security because you get to participate in the quorum, which protects your collateral.
Very nice.
So that's not just to be clear, that's not live yet. It's coming very soon. I'd say sometime in the next month. But our existing solution is multi-sig. It's just internal.
Okay. Now you said, you kind of mentioned that someone doing this, like the point of not selling and putting it in a custodial solution or situation would be that you think and hope that it's going to go up in value. How do price fluctuations affect what you guys are doing or the loan process or the payments or whatever?
Right. Anybody who's in Bitcoin or any cryptocurrency understands that it is extremely volatile. It's not as volatile as some people pretend that it is, but it is volatile. And so the way we consider this, volatility is something no one can control, but we can trade it back and forth with the borrower. So the way we handle that is when we originate the loans, we expect to be at 50% loan to value ratio. That means if you'd like to borrow $100,000 from us, maybe you're buying a house, you're doing some home repairs, whatever your reason is, if you want to borrow $100,000, you need to give us $200,000 in Bitcoin or Ethereum at the origination date. And so that sets kind of a guide rails for us. And we want to keep you at around that ratio. So if the Bitcoin or Ethereum price, whichever the collateral is that you're lending against, if that were to fall, there's various thresholds, and you can see it all spelled out in detail on our website, but there's various thresholds. I believe at 25% drop, we're going to send you a notification. You can think of it like a margin call if you've ever done a similar kind of asset-based lending in the brokerage context. You're borrowing against your Apple stock, for example. We'll send you a notification saying, hey, look, the price has dropped to this ratio. We need you to put in this much Bitcoin or this much Ether, or we need you to pay back this many dollars of your loan in order to get that ratio back to being healthy. And so we really leave it up to you. It's your choice what you want to do. You have 2 business days in which to act. We'll continue to monitor the price and stay on top of it. But once you decide what to do, then we go back to the ratio. If you don't respond, if you don't correct the ratio, the price can fall further. You may be subject to a liquidation event. So eventually, if the price drops so far that we're worried about being able to cover the value of the principal we've extended to you, we have the legal right. You will be in default, and we'll be able to sell your collateral on an exchange or an OTC desk, and we'll use the proceeds to cover the principal that you owe us. And so far, we can talk about, how we, survived the massive pullback in the crypto market between December and March of this year. It was a harrowing experience for many companies in our space, and we came through it just fine because we have a really proactive process around this, that we make sure our customers know that these ratios are happening. And truthfully, our customers don't want us to sell their crypto. That's the reason they borrowed with us in the first place, as I mentioned. And so during that time period, I mean, we have some 50 or 60 borrowers. Our average loan sizes are, more than $100,000. These are big loans. These are borrowers with a lot of crypto, and we didn't have a single default event during 2018. That despite the 70% pullback in Bitcoin's price, let's say between January and March, not one loan that we made entered default. Every single borrower either paid paid back some principal, or more commonly gave us more collateral. So gave us more Bitcoin, gave us more Ether in order to correct that ratio. In particular, the average amount of time that it took for us to get more collateral from our borrowers was less than 8 hours. And that's pretty remarkable.
Yeah, that's impressive.
Yeah, like in most situations when you're lending against, let's say, property like people's homes or cars, it can take days to weeks to months to correct the ratios of principal to collateral. But Bitcoin and Ether, these are digital currencies. There's no weather to worry about. There's no family living in the house to worry about. They're efficient, they're fast, and that's really attractive to lending capital providers who look at this. And I think something we're trying to assert as a company in this space is that crypto is in many ways the ideal form of collateral. Like, yes, it is volatile, but look at it from all these other perspectives. It's really good collateral. It's digital, it's instant. You can program in your right to perfect it. Like, that's pretty powerful stuff. So that's how we handle the negative aspect of volatility. When the prices are falling, we're going to notify you. We're going to expect you to give us more collateral or pay back some principal. And demonstrably, our history has shown that we've done a good job being proactive about that, and that our borrowers really value their collateral. They don't want to lose it, and so they're just as perseverant about keeping that ratio healthy as we are. On the flip side of this, the prices also go up. Right, that's the whole magic part about cryptos. Occasionally, the prices will go up by factors of 10 and 20, as they also have done in the last 12 to 18 months. So in those situations, as the ratio, as the collateral to principal ratio, which started at 2 to 1, you're giving us $200,000 in collateral to borrow $100,000. As the prices rise and that ratio crosses 250%, you'll get a refund. So you can just take back some of that collateral. We don't need it anymore since your loan is now even more collateralized. It's nice to have even more collateral to protect the principal that we've extended to you. But if you think about it, it doesn't really help us to have extra collateral. We'd rather we gave it back to you so that you can use it, maybe take out another loan or use it somewhere else in your life. So again, no one can control volatility, but we can trade it back and forth with each other to handle price increases and decreases in the market.
It's comforting that you guys have thought of all this.
I think one thing I might add too is we want it to be comforting. Like, it's dangerous. It's scary when you get margin called. Like, I think the only thing that can make it worse is if we did it automatically, and if there weren't human beings on our side that you could talk through while it's happening.
Right.
So I think some of our competitors, they make a false virtue of how automated their systems are, and they can automatically sell your collateral to fix the same problem. They can handle it automatically. I don't think that's what borrowers really want. Borrowers want there to be human beings in the mix that can make an executive decision. They want to be able to reach out to someone and speak to them and talk to them and understand what's happening very directly. We automate everything in our business, but we do not automate outflows of cash or crypto because we don't view that as a very safe or responsible decision.
Yeah, and I was kind of thinking like, okay, so what if I had taken out a loan in, let's say, August of a year ago, and how much it went up, but then also how fast it came back down. And so you wouldn't want that automated by any means because you're just going back and forth and back and forth.
Yeah, I mean, again, we like automation, but we do not automate any kind of sale of collateral. nor do we automate any kind of cash transfer. If you think about it, even to automate moving digital currency, if you can really do it automatically, it means it's hot.
Yeah.
Like, we don't store collateral in a hot way. It is 100% stored in cold storage. Multiple human beings in multiple geographies need to collaborate simultaneously in order to be able to move it. It is not something we can do automatically. It's by design only possible when multiple human beings collaborate to solve the problem. And so we like that. We like having to communicate about it. We like having a certain minimum amount of time that it will take us to react. And it's more than fast enough to handle market volatility, but it's more importantly, it's slow enough where we're going to catch, we're going to intercept, false flags or the ability to be hacked, or we're going to give you time to be able to react and talk to us. I think that's the much safer approach. Again, our goal is not loan to own or to have millions of customers. We want to help preserve your Bitcoin. We want to help you do that. And we are only ever going to have a small number of customers who have a large amount of crypto assets. That's the nature of our business. And so because we're not an exchange, we can afford to have this 100% cold storage based model and really diminish our security surface that we have to protect. And as an engineer, that makes me feel a lot safer.
Yeah, definitely. So are there stipulations on the type of loans you guys do? I mean, do you do specifically like this is specifically a home loan or a car loan or a small business loan, or is it just kind of a, I don't know. I'm not big, super familiar with the financial world and how all that stuff works. I know that traditionally you would have, like if I went to go buy a new car, I guess I'd go get a loan from the bank or do financing through that dealership, which is going to be different from if I, when I bought my house or whatever. So how is that different for you guys? Do you only do certain types, or is it kind of whatever?
There definitely are a few different types. It's not so much based around the purpose of the loan, more the identity of the borrower and the location of the borrower. But, brief review of what the regulations are here. Again, part of the reason our business even entered the lending space is because lending is fairly well regulated, but at the same time has a somewhat lower barrier to entry than other kinds of products we might have wanted to build, like derivatives or fixed income products. In the United States, there is no federal body which regulates asset-based lending in the same way as the SEC regulates securities or the CFTC regulates commodities or like that. It's done by the states. In many states, there are no licensing required. For example, here in Texas, if you and I want to give a loan and engage and be a borrower and a lender with each other, just as two individuals, there's no licensing required. We can do it right away. In other states, there is a license required, sometimes only for consumers, but not for businesses, sometimes vice versa. Many states, there are interest rate or amount kind of guide rails. So if you're lending with low interest rates or large amounts, you don't need licenses. Many of the laws which exist are really designed to regulate or make difficult the kind of more predatory payday lending to poorer folks. So that's not really a category we fall into so much, so we can kind of avoid that. But in many cases, like the state of California, a great example, we have to go out and get licensed. We're actually the only crypto-backed lender that is licensed in the state of California. And there are a lot of borrowers in California, so that's kind of nice for us, right? We took the trouble and we did the research early and realized that we needed to do this, and so we went and got licensed. In terms of types of loans, really that's what it boils down to is, what geography are you in, which state are you in? I think we can only operate in about 35, 40 states right now. There's a list on our website. You can take a look. And in some states, we can lend to both consumers and businesses. Some states, we can just lend to businesses and not consumers at the moment. So that's really the first question we would ask about a loan. As for the purpose, as long as it's legal, you can use the loan for almost anything. I think the number one purpose that we tend to see both across consumer as well as business borrowers is real estate. It's, I think, really satisfying to be able to take a completely, internet magic beans digital money and turn it into a home. That's a very cool thing to be able to do without having to sell it, right? Using leverage and our product to be able to do something like that. I think that's the most common use case that we see. And followed by that is typically investment of some kind. So maybe, buying a business or making an equity investment in a business, and using your Bitcoin, which is already sort of, it's liquid, but you're kind of hodling it. And since you're hodling it, it's sort of you're not using it for anything. Why not leverage it into kind of an illiquid investment, like an equity position you're taking in some business? So that's pretty common too. We also do see just leverage for investment within cryptocurrency. So like, can I borrow on my Bitcoin to get cash and then buy Bitcoin with that cash? Like, yes, you can do that. If you're really confident that Bitcoin is growing, that's a really good strategy to expose yourself to even more growth. But of course, it's extremely risky when the market is headed downward. Early on, we were worried that would be like the chief and only reason why someone would want a Bitcoin-backed loan or a crypto-backed loan. But it turns out actually to be a fairly small minority of our loan book. Most people are borrowing for real estate.
What about eligibility? I mean, I know you said earlier that you don't really run much of a credit check. Is it just basically, is the requirement essentially that it falls within each state's legal boundaries and then they've got a certain amount of Bitcoin or Ether, or do you screen for like, hey, this person's not likely to pay us back, or how do you do that?
No, I mean, you have it fairly right. Like, that's one of the advantages to asset-based lending is we have the asset. In fact, we have a doubly secured, doubly collateralized amount of Bitcoin for the risk that we're taking in giving you dollars. So if you don't pay us back or you run away, we can sell your Bitcoin and we have enough of it that we're going to be okay. You are the one who's going to lose out. And so we don't really have to worry as much around, are you a trustworthy person? Are we taking a big risk on you? So that's the reason we don't have to do a hard credit check, because we're not dependent as compared to, let's say, an unsecured loan where there is no collateral, where we're just relying upon you to pay us back. Like a credit card is a good example of that. There's no collateral there, right? Except that there do exist collateralized credit cards, and they exist for people who have poorer credit. And they will have collateral in the form of money that you've paid up front. But in general, credit cards are unsecured. And so it's important that you have a good credit score if you want to get a credit card with a high limit. Whereas for us, if you need to borrow a lot, you just need to give us a lot of assets, and we use those to secure your loan. So, it pretty much does boil down to, are you allowed to lend to a person or a business in your state? When you go through KYC AML, like, is it believable? Are you a real person? Are you on a government watch list of people we shouldn't be working with? If you clear all those things, then we are going to ask you about your source of funds. Like, we want to know if you're showing up with $1 million in Bitcoin. We're going to ask you, where did you get this Bitcoin? We don't need receipts or complex histories. We don't do like backwards looking chain analysis to figure out, whether your Bitcoins or your Ether is tainted. We don't take it that far, but we do ask you. We ask you to self-report. And what we find is that most people who are looking for our service are extremely willing to tell us how and when they got their Bitcoin, tell us everything about them, because they trust us and they want to work together. Folks who are unwilling to have that conversation or give us that information in general, maybe aren't worthy of as much trust, or maybe this service like this is just not for them. I think sometimes there can be a tension how distributed and decentralized and trustless Bitcoin is versus how much trust and knowledge and private data must be exchanged between two parties, like a lender and a borrower, given the regulations of a country like the United States. But the value proposition of being able to get dollars while holding your Bitcoin anyway is really high for some people, and so they're willing to do it. But yes, there aren't any really special requirements. As long as you've got enough assets and we're allowed to lend to you and we believe you're not a criminal or anything like that, we can make a loan. And we can move very quickly. Usually our turnaround is usually in about a business day. Wow,
that's really fast. Yeah. I'm just sitting here thinking about when I bought my house. It's like, oh man, it's like it drug out forever. But yeah. Well, and that's a good thing for younger people or people who maybe don't have much credit either way, right? Like they haven't gone and taken out a bunch of credit cards. Right now in the traditional system, you're kind of punished for that. It's like, if you were someone who just didn't have credit cards or haven't taken out any loan, didn't take any student loans out in college, maybe your parents paid for it or something. It's like you want to go buy a house. It's very difficult, or I don't know, even changing like to, let's see, like I know when we first, when I first got married and we moved on to our own cell phone plan, right? Like everything had to be under my wife's name because I didn't have any credit either way, really.
Right.
So this is a cool thing for people who just don't have, maybe it's not bad. Maybe they haven't messed a lot of things up, but they just haven't built that credit in the system up yet. But they do have Bitcoin or Ether. So, this is
and you can see how it happens that way, right? Like, how is an entity that's never met you, that doesn't know you from Adam, going to trust you? They're gonna need that credit score. They're gonna need that synthesized gossip out of what every other entity like them thinks about you. That's what that number is. And I understand why they want it. And if you're someone who has a lot of means, like you have land, you have stock, you have gold, you have other assets, there are ways to get, credit and liquidity without having an actual credit score or while having a low credit score, let's even say, because you have those assets, right? But there are very few assets like that which are easy and digital. And I think that's what's so cool about Bitcoin and Ether, that they are assets that you can just have, and they're also just digital, like a credit score. And so you can work very quickly, and you can work with remote companies that you don't have to meet in person. You don't have to physically move something from one location to another in order to be able to get the liquidity. And that's a really cool opportunity, especially for folks in our generation, many of whom have acquired cryptocurrency and are doing so now, and 5 years, 10 years from now are going to be in the market for a home. And no bank is going to recognize their digital assets as real, at least not today. I think that's in some sense the most radical thing that we do at Unchained, is we just acknowledge that digital assets are really worth something, and actually form a really good form of collateral, and we can build a business on that.
Yeah, this is going to be a big deal. And I think I'm kind of the outlier, like you said, in our generation. There's a lot of people who aren't homeowners yet, or move around a lot, maybe.
It's hard for our generation to own homes. Yeah. We're kind of priced out of it.
Yeah, that's true. I kind of ended up with a good deal. So it was kind of anomalous as opposed to other things in this area. So yeah.
And I get it. I mean, that desire to own something that's meaningful and as a hedge against inflation, like real estate, is so powerful. When I sold my company, it was around 2013. It was the first time in my life I had, more than a couple $1,000 at once to do something with. And I immediately bought a condo, and I immediately bought some Bitcoin. And I think partly driven by the same impulse that, like, I wanted to get a piece of something that didn't decay every time I held it.
Yeah.
And I also bought a lot of stocks and bonds, and got a pretty traditional financial management program going, had to learn a little bit about how that worked. But if I hadn't had that win, if I hadn't been lucky and hardworking and managed to, sell a company and in, my early 30s, like build a little nest egg, I don't know, it would have been very, very difficult for me to be able to save up and build the credit and build the savings to be able to get a home. And I think that's something that's really cool about the service that we provide. I feel very privileged that, we are helping people who are, who were smart and who were hodlers and who were disciplined, who were able to hang on to a good amount of crypto wealth that they acquired early, sometimes by luck, sometimes by vision. But we're able to get them into a real physical home. That's really cool. And we don't require that they sell out the asset class that they're so invested in.
So a lot of people that I interview on the show are doing things that are very much digital, and your business model is digital, but you're really affecting the real world too. So that's very cool.
And that's kind of our thesis, right? When we were looking and thinking what we wanted to do in 2016 or so, Joe and I, my co-founder, when we really committed to wanting to be Bitcoin and cryptocurrency entrepreneurs, it's like, whatever Bitcoin is or was trying to be at that point, it's got to be connected. It can't continue to be like this little sidecar that's just, for anarchists and crypto libertarians and guys that eat too much meat and whatever else, in the corner over here, right? it needs to be connected to the economy. There needs to be demand for Bitcoin in the traditional fiat world. And a product like ours creates that, right? Our interest rates they're not low. They're 12 to 14% APR. That's not something we set. That's a market-driven result between what crypto owners are willing to pay to access liquidity and what capital markets are willing to lend at given their perception of the risk around cryptocurrency, which, by the way, is extremely high. They're right to point out that Bitcoin's not even been around 10 years. It's hardly as safe as Apple stock, much less someone's home in a 200-year-old city or something like that, right?
Right.
So there's a lot of conservatism from the traditional markets, yet our rates are attractive. And so we're creating a reason why folks in the traditional capital markets who don't have anything to do with cryptocurrency, we're creating a demand pull on that side for, hey, this is a really safe loan. This loan book is really well collateralized. I like how digital and quickly the asset can be recovered in the event of a market downturn. The company is trustworthy, and 12-40% is a really nice rate to access. It's almost a way for more skeptical, larger fiat-based organizations like in the capital markets to get exposed to cryptocurrencies and get exposed to a return from the cryptocurrency industry without having to actually hold Bitcoins or hold Ether, which I think is still a little bit difficult for a lot of those organizations to do. It's often repeated that one of the cool things about the crypto revolution, if you want to call it that, is unlike many other technology revolutions, it started at the edges. Right? It didn't start with big companies and high-tech places. It started with just individuals buying in from the fringes on this thing that now, increasingly large institutions in the middle are realizing is happening and want to be a part of. But many of whom can't actually get there now. I think our product is a nice halfway point. It's a bridge in a lot of ways between the traditional world of capital markets and everything that's happening in crypto.
Yeah. It is that way because I'm trying to remember what I was watching or listening to, and they were talking about how, like you said, it was kind of reverse of what a lot of things happen. And when you see bubbles and stuff, and it's like, in the housing bubble, right? It's like when it got to the point that the taxi cab drivers and your grandma were wanting to flip houses, like that's when you knew it was a problem, when the everyday person was in this class. And versus just the big financial guys in it, and it's working the opposite way now with Bitcoin.
So does that mean we hit the top when? I guess it kind of does. I mean, we'll know that we've succeeded, so to speak. We've hit max saturation when the biggest, most conservative, most originally against Bitcoin and cryptocurrency firms and institutions and regulators kind of embrace it. Maybe that's the lesson.
Maybe. So what differentiates Unchained? You said there's other crypto-backed lenders in the space. What makes you guys different?
Right. I think the two or three simple things that we've really focused on over and above almost everybody else in our business are simplicity of our product design, our company, and how to work with us, as well as security around our business, our team, operations, and most importantly, the collateral that we're custodying for our borrowers. Those are the two areas I think are leaps and bounds ahead of our competition on. So in particular around simplicity, there are a bunch of competitors, like a couple that I can name, who I would paint as overly complex because of the design of their business model. Folks like Salt, Celsius, Nexo, these are token-based businesses. For some reason, they want to do the same thing that I do without a token with a token. I don't know what the value of adding the token is. It seems like the value is people will buy the token, so why not have one? Like, okay, I get it. But we just went through a year of that pattern, and I think companies like mine, which are succeeding and growing steadily and have really happy customers, versus if you look at the recent drama and that's been happening around Salt, where their CEO has left, the borrowers are extremely angry, the terms are constantly changing, the relationship between borrowers and the token and the company itself is changing as perhaps management realizes that some of the promises they made and assumptions they made around this token aren't really working out very well for them from a regulations and legal perspective. And so I think being simple and just realizing that you don't need a token in order to give an asset-based loan on an existing token. You don't need your own token to do that. That just makes for a better product, makes for a better experience. It's a simpler business and it works better. So I think, I salute, one of my competitors, BlockFi, another firm like ours that has no token. They're trying to do what we are doing. They're realizing that you can, like we have, you can do it without a token. And I think that's the first major differentiator in our market between ourselves and almost everybody else out there. I think the second major differentiator, and in this on this point, I think we are the only ones that are thinking this way, is that custody is king. That is the most important aspect of our business. It is the thing I stay up all night thinking about sometimes. If we lose your Bitcoin while we have it, there's nothing worse that we can do. And so much of our business is designed, so much of our energy, so many of our internal resources, man hours spent programming are around this issue. Now, I think a lot of our competitors, because they don't have tech teams that are as capable as ours, they don't come from a background of being engineers in distributed systems and mathematicians and physicists like we are. They don't want to tackle these problems. They want to instead say, hey, we've taken all your borrowers' funds and we've put them onto Gemini. We've put them on an exchange. We're just using BitGo. That's a lazy answer. Those services are great. I've used Gemini, and we have a relationship with Gemini. They're an exchange partner of ours for liquidations and other escrow operations that we would need to do. Nothing against those services, but I wouldn't want to store my borrowers' deposits on those services. Exchanges are designed for trading. They're not, in my mind, designed for long-term, super safe, cold storage of collateral. After all, if you borrow with us, and let's say you take out a 2-year loan, why do we have to poke that collateral before 2 years from now? Why do we need to put it in an exchange where it intermingles with everybody else's Bitcoin or Ether, where we lose the relationship between your collateral and an address in a blockchain? Why do we have to give that up? We know that we're never going to touch it except for 2 years from now. Why not put it in cold storage in a dedicated address? You can watch it for all those 2 years. You can feel good about it. And 2 years from now, when we need to transact with it, let's take the hour it takes to summon all the people involved who are humans and then free it from that cold storage. Doesn't that sound safer? And I think the reason that is not pursued by a lot of our competitors is because it's more difficult. It requires more engineering. Multi-sig cold storage is, even in 2018, it's not a completely solved problem. A lot of the code that we release in open source is related to this problem. Just as an example, in Bitcoin, it's actually quite a bit easier to do multi-sig cold storage. It's an older and simpler protocol. In Ethereum, it's newer, it's more complex, it's more capable. There hasn't really been a good smart contract in my mind that I trusted that was compatible with hardware wallets for cold storage, and that was multi-sig, and that was simple. BitGo and Gnosis have both released candidate contracts, but they're way too complicated. They have the ability for you to change the owner of the contract. Why do you need this functionality? It is functionality like that which led to the bugs in the parity multi-sig contract. If you remember what happened around that last year, fundamentally the attack vector came from functionality in the contract that allowed you to change its owner. Why do you need that functionality in a contract that is only designed to keep stuff safe? Why can't you just flush from one contract to another contract with a different set of owners? It's like that over design that hey, I put in every possible feature I could think of. This is so abstract. This is so complicated. This is so general. That's an anti-pattern in cryptocurrency, where we are not collectively as a species good enough at engineering distributed smart contracts yet. We should keep it simple. And so, before we could even lend against Ethereum, we had to go out and we had to develop the simplest possible multi-sig contract we could think of. We released it, we open sourced it, we actually ran it through a security audit by Hosho. They did a great job giving us a clean bill of health. And we've been running a bug bounty. There's a $150,000 bug bounty we've been running for the last 6 months or so. It's never produced a significant bug in the contract because it's so short and simple, there's almost nothing to say there. So this gives you an idea of how much work and time and energy we spend on this idea of custody, and how forward thinking we are, I think, compared to our competitors, realizing that one, what you want is cold storage, what you want is hardware wallets, what you want is your own address. And then even as I've mentioned earlier in today's conversation, going forward in the next month, we're actually going to open up that structure, and we're going to let you have one of the keys to this multi-sig structure, and we're going to let your hardware wallet be part of the quorum that protects your funds. There nobody else in our industry is thinking about the problem they're solving as a custodial problem. They're content to think of themselves as lenders and then outsource the custody problem, just like they outsource customer service and various other aspects of their business to other firms. That's not how we operate. Like, when you call us, you get an Unchained Capital employee who's intimately familiar with your account, whose name you're going to come to know, and who knows you and understands like your loan and your payments and what's going on with you. You get your own address. You have a lot more confidence, I think, when you work with us. And you don't get a token, but I don't think you really wanted a token. I think what you wanted was a safe place to borrow while you paid for expenses in your life, while you continued to accrue gains on your crypto.
Yeah, Drew, so something you said while you were going through all that, and I think you kind of said it earlier, but I didn't catch it originally. You know, when you guys, like, when a customer transfers that fund to you, they've got the address that it went to, so they can, like you said, they can monitor it as well. I don't know why I didn't think of that before, but like, I could go pull up the, Sentinel app and put that address in, and if it ever moved, I would get an alert on my phone.
Yep, that's exactly right. Whatever blockchain explorer or wallet you want to use, most of them have a watch functionality or an alert me functionality. Throw it in there, and we'll alert you obviously if it moves.
Sure.
But if you don't trust us, and frankly, you shouldn't. You should always be paranoid. Always think of security in terms of layers. Go ahead and set your own watches on that address. But the point is, you can't. That address is not used for anybody else's loans or anybody else's collateral. It's never rehypothecated. We don't move it from there in order to make money for ourselves in some other side business. It's your Bitcoin. You still own it. All we have is a lien against it because of the debt that you took on when you borrowed with us. They're your Bitcoins or Ether, and you deserve to be able to look at them on the blockchain, since that's what the blockchain was built to do. It's a custodial engine. Why not use it?
I love that you guys are thinking this way, because I've seen so many businesses that I feel like, we'll get 2X, Segwit 2X last year. I mean, that's kind of the biggest example, right? But of companies trying to push Bitcoin to fit their business model, rather than making a business model that works with Bitcoin and makes use of Bitcoin the way it is supposed to be. And so I love the way you guys are thinking. What's next for you guys?
So as you can imagine, given how much effort we have put into thinking about custody and protecting funds, we're the only lender that really, spends time on this aspect of our business. We are going to start stepping into it a little bit more fully. That right now, if you want to access our very convenient and useful custodial service to keep Bitcoin safe or Ethereum safe on hardware wallets spread out amongst multiple entities that are collaborating, you have to take a loan. But we've heard from our borrowers that they would be interested in that custodial model even for funds that they're not borrowing against. So just, why not just give us the funds and put them into a multi-sig, multi-institution address that you, ourselves, and a third-party escrow agent collaborates in order to protect? And so that's not a feature we're going to be releasing this month, probably in the coming quarter. We want to understand a little bit more from our existing users, like what the parameters of such a product would be, how we would charge for it, how they would want to use it. But I can see us stepping more directly into the custodial space. And that's kind of nice for us. It's a totally different kind of product. The internal cost structure around it for us is very, very different. But at the end of the day, I mean, really, it is the same technology. It is custody. It's much easier for a company that's really excellent at custody to build loans, to build fixed income, to build other classes of financial instruments than it is for a company that just does loans on a spreadsheet and with a Gemini account to suddenly start building other lines of business. And I think that's the investment that we've made over the last year or two, which is really going to pay off in the coming years as we focus on beyond loans, things like vaulting technologies, things like fixed income, leveraging the Lightning Network and the ability to stake in Ethereum. These are cool ways to get income back to our borrowers and our depositors. So I think you'll start to see us grow into new product categories. And it's part of the reason we don't call ourselves Unchained Lending. We're not just a lending company. We're a technology company with a strong custodial solution that started in the lending vertical and is going to expand into even more useful and interesting verticals. And I think the trust that we have earned with our existing borrowers, many of whom you know the names of, they are people whose tweets and articles you read. Many of our existing borrowers, I think, because they trust us, they'll go along with our new product lines, or at least that's my hope, is we've convinced them because of the pain we're solving around lending to start working with us. But once they're in our orbit, they're going to want to stay there.
That's exciting. What are you like with Bitcoin or Ethereum or other cryptocurrencies, on that side of things? What are you most excited about, or what do you see down the road for Bitcoin or for Ethereum or whatever?
Man, there's nothing more interesting to me right now than solving the scalability problems that both Bitcoin and Ethereum experience. Bitcoin, the discussion around scalability has been going on for years, as anybody in the ecosystem is aware of, right? The block size debates, the Lightning Network, segregated witness, transaction malleability. These issues are all intimately connected, and they're about hey, Satoshi delivered to us this really cool system, which is incredibly hard to scale. How are we going to preserve the values of robustness, censorship resistance, decentralization? How are we going to preserve those things while getting to Visa scale, while replacing sound money, while building a world computer? It's extremely hard to just have both things at once for free by adding a couple lines of code. Teams that believe that are deluded. This is a really hard engineering challenge. So how are we going to do it? And watching that happen and watching that grow is something I'm totally fascinated by. I'm excited because I think it creates new opportunities. As I mentioned before, both the Lightning Network, which is a scalability solution for Bitcoin, as well as proof of stake, which is a new consensus model that Ethereum is trying to switch to. These are both in protocol opportunities for folks who have the relevant tokens, BTC and ETH, to earn a return. That's really interesting. That's a very healthy aspect of these ecosystems. Even on your show, I think you just had Nick on a couple weeks ago, right? Talking about the Lightning reference rate.
Right.
That's a really healthy development. I think like liquidity, which our business offers, like increased sophistication around custodial solutions, these are parts of what indicate that crypto is really maturing. So I'm extremely bullish and excited because of those kinds of developments, something I'm really looking forward to seeing develop.
Let me ask you, having to work with both Bitcoin and Ethereum, what are the biggest differences or challenges of each?
Right. No, that's a really good question. I almost think of, for the programmers out there, I think of like Bitcoin and Ethereum almost like Fortran and Lisp, right? Like they're both, sort of early attempts at solving the problem that couldn't be more different and arguably have exposed really valuable areas of concept space, so to speak. They're both like the beginnings, the progenitors of a family of attempts at being a blockchain, right? But they are extremely different, and they're very different to develop against. So Bitcoin, my developer feeling is, man, this software is good. Like, it's confusing. It's not necessarily well documented, but it works very consistently and it almost never breaks. But at the same time, it moves slowly, at least compared to Ethereum. Ethereum moves a lot faster. The software does break often, like Parity and Geth and tools in the space do break because the protocol is evolving so quickly. It can do so much more. It's so much more capable. But sometimes I will say that in the case of Ethereum, I think that leads to, hey, we can do it, so we should. And as we've discussed with the parity hack, I don't think that's a good design philosophy for the distributed world. Like we don't have a in traditional software engineering, there's the concept of application lifecycle management. Like we know how to develop an application, we know how to deploy it in production, we know how to iterate against it, and we know how to improve it while continuously servicing, users and of the application. That process is not really real for cryptocurrency. If people are using smart contracts, there isn't a well understood way to manage the lifecycle of smart contracts. We're just now figuring out that smart contracts have multiple life stages, as various projects have gone through their first iterations and need to transition. It's extremely hard to engineer well in this totally distributed adversarial smart contract based universe. I think a great example of this is another one of our competitors, ETHLend, which I think started out trying to be extremely distributed and smart contract based and so on, which there's a lot of value in that. I think that's a cool approach one day when these systems are vastly more scalable. Our system, by the way, we use smart contracts for custody of collateral. Everything else about our business is centralized. We use Postgres. We have servers. Like we are a very traditional business from an IT perspective in a lot of ways. It's just where we touch custody, that's where we touch the blockchain. A business and a company like ETHLend, they try to do everything on the blockchain. Everything's in smart contracts. And it seems really cool. It seems like what you want, except for what happens when you go through really bad gas weather, right? Like, I don't know if you've been following the last few weeks, but there were some remarkable days where gas prices were through the roof in Ethereum. Orders of magnitude higher than they've ever been before, and just for a short period of time. And services which were 100% smart contract based grind to a halt when things like that happen. When your business logic is subject to market economics of gas, it's extremely difficult to have predictability because those markets are also very volatile and subject to adversarial attacks. There's a lot of evidence that the gas prices were so high in Ethereum during those intervals because of attacks from adversaries from other blockchains who want to mess with Ethereum-based applications and want to show that Ethereum suffers this problem of not having a centralized ability to clamp down and regulate gas prices, which of course it doesn't. It's a decentralized system. And so I think just because you can build it in smart contracts in Ethereum, it doesn't always mean that you should, especially in today's early, naive infrastructure where we don't really understand how to build complex things in smart contracts. We've not been doing it for a long time. The markets are very volatile for gas. It's not a very scalable idea. I think it's cool as a proof of concept. It helps us push the envelope. It helps us understand what these blockchains really need to do one day when they're quote unquote grown up and real. But what I like in particular about Bitcoin is it lacks that complexity. It's really just not smart enough to do those things. And so there's only so far you can push it. And that's not to say it doesn't have its own issues around fee pressure or lack of scalability. It absolutely does. But I think those problems are a lot easier to solve with second layers like the Lightning Network than the equivalent problems in more capable Turing-complete chains such as Ethereum. And so I think we'll scale something like Bitcoin much before we scale something like Ethereum. And that tends to shape my own attitude towards those chains. I think they're both extremely valuable, and I enjoy writing code for both of them. They both make me think somewhat differently. But it seems clear to me that because of its greater focus and simplicity, what sounds like a weakness is actually a strength in Bitcoin, and means that it'll scale first, it'll be more secure, and then only after that will we be able to bring some of those insights into Ethereum, and then that will finally enable applications like Augur and ETHLend and so on, which are wholly smart contract driven, to be a lot more useful. I think today those are a little bit early.
So, are you guys running any for Ethereum? Do you guys run nodes? Like, do you run any full archival nodes?
Yeah, we run full nodes for all the chains that we participate in. We do not like to use blockchain explorers or any kinds of APIs if we can avoid them. We see no reason to leak any data whatsoever about our operations to external services up until the point where we are publishing transactions to blockchains. That feels like the first time the world should know about anything that we're up to. Now, with that said, with Ethereum, I don't think our node is in the fullest possible state. I suspect that we are still snapshotting to some degree from the network. In Bitcoin, of course, we're a complete and full participant equal to any other. But I think just given the implementations of parity and Geth today, I think we are probably not doing the fullest possible job being Ethereum nodes that we could be. That's something I'm interested in changing. But for now, I've actually had so many issues with keeping my my parity and Geth nodes happy as compared to the number of issues I've had keeping my Bitcoin D nodes happy, that I'm actually accepting that difference, and I'm allowing us to run, not total full archival mode in parity and Geth, but I'd like to get there. And I think as we add more nodes, BCH, Litecoin, so on, I think it's the same philosophy. I'm also, my background as a physicist and a data science guy. I like having the full nodes. I like having the data. I like having that ability in our team to be able to quickly go run a script or a calculation or analysis over the historical data of these systems. It drives a lot of, I think, our intuition around how to build product as well as what's happening in the marketplace. And it's a differentiator as well. There's no other lending or custodial company that's spending as much time putting out interesting and original content on just, esoterica around Bitcoin and Ethereum's history on chain as we are. A lot of the blog posts on our Unchained Capital blog, which have done the best, including a hodl waves post, which I think got a lot of traction, ultimately come from us just being dorks and wanting to poke around with this data because we have access to it because we have full nodes. And how cool is that?
Yeah. So now we're got me thinking, because I had Stop and Decrypt on, I don't know, back in early July, I think, and he was kind of going over all these issues that Ethereum was having. So that's what kind of made me think of wondering if you've had difficulty keeping synced. So yeah, but you're right. Like it would definitely differentiate you, because my understanding is it's getting harder and harder to keep full archival sync with the Ethereum blockchain, and it's good just to have it for Bitcoin as well. I mean, especially you guys' whole model is custody and security. So yeah, it makes sense to have all of that information. All right, Dhruv. So anything else you want to talk about or anything else you want to plug before we say goodbye?
No, this has been a great evening chatting with you, Josh. And to anybody listening, come check us out at unchained-capital.com. If you're interested in crypto-backed loans, take a look at our service, join our mailing list, find us on Twitter. We'd always love to talk to folks in the Bitcoin and Ethereum spaces about borrowing, around security, custody, historical data analysis. We are passionate about what we do. Come talk to us.
Very cool. All that stuff will be in the show notes. This is episode 26, so bottomshelfbitcoin.com/26. They'll have links to Unchained Capital and your guys' Twitter feed and all that stuff. So yeah, thanks Dhruv for stopping by. It's been fun.
Thanks again, Josh.
All right, take care. All right, Bottom Shelfers, you know the drill. Help us out by giving us a good review on iTunes or Stitcher or whatever other podcatcher app you use, and share the show around with your friends and family, and catch me on Twitter and Mastodon at BottomshelfBTC. For Mastodon, that's the bitcoinhackers.org instance. I did move over. I don't know if I've mentioned that. If you hadn't caught that yet, I did move over. And yeah, go check out Dhruv. Go check out Unchained Capital. Some really cool stuff they're doing over there. And I did want to mention, if you want to, a couple of ways you can support the show financially. Obviously, you can get on Patreon, patreon.com/bottomshelfbitcoin, and support me with one-time or recurring payments in fiat. You can donate Bitcoin via my Paynim. and that'll be on bottomshelfbitcoin.com/donate. You can buy Tuttle Twins books through my link, bottomshelfbitcoin.com/kidsbook. Those are great books for teaching free market economics and ideas of liberty, et cetera, to kids and also adults too. The other thing I wanted to announce, and maybe you saw, I posted a picture not too long ago that said good things are coming. I have gotten some embroidered patches made, which I think are pretty cool. And I have not revealed them hadn't put them up for sale yet because I was waiting and trying to get into contact with all of my current and previous guests to give them, to let them know that I was doing that and send them theirs, just as a thank you to them, but also I wanted to open that up to listeners as a way to kind of support the show. So these are, I think, 2 or 2.5 inch round, my little kind of neon blue Bitcoin logo, and they're Velcro backed. So I will be working on getting that store section of my website up and running here in the next week, so that if you are interested in purchasing one of those, you can. Sorry to international listeners, I have not gotten international shipping figured out yet. I hope to, not too long from now, but for starters, we're just going to say US listeners. So sorry, international listeners, I do appreciate you guys, and I know there's a bunch of you out there, because I've looked at the statistics, the analytics distribution, and so thank you guys for listening. And unfortunately, I don't have that figured out yet, but we'll get it figured out so that you guys can participate if that's something you're interested in. All right, yeah, that's all for this week. From Bottom Shelf Bitcoin, I'm Josh Humphrey. Thanks for listening.